Bring in Steve Wieting, Global Chief Investment Strategist at Citi Private Bank. Also, of course, Mike Santoli's here with us. Mike, a couple of the headlines from that. Quote, we don't need accommodation. Quote, I think we should wait. Clearly making it apparent that an insurance cut is only in very extreme circumstances, one that's not warranted at the moment. In
Exactly.
His view.
Citing stock market at all-time highs in the U.S. as well as low unemployment. Very clearly articulated case for why the data themselves do not necessarily dictate a move here. And I think more than anything for the market, it doesn't necessarily tell us that much about ultimately how the committee is going to vote on July 31st. What it does suggest is there are three very plausible, defensible positions going into this meeting, which is no cut, quarter point, half point. That creates just a general fog of uncertainty, given the fact that the bond market is priced 100% chance of at least a quarter point cut at this point.
Steve, what's your take? And does this alter whether you want to be bullish on equities when you hear someone so clearly articulate a point that no cut is needed, and we all know the equity market is priced one in?
Well, look, our position on equities would have to take into account a great deal of policy uncertainty right now. And if we were entirely dependent on Federal Reserve rate cuts, we probably would have a problem with our outlook for risk assets. So we're going into this with a little bit more caution, perhaps, than others, a little bit more caution in our asset allocation, perhaps versus what is warranted. But I do think that this particular speech is on the hawkish side. It's to be expected, given that Rosengren's position, I think, has been fairly clear about the stability of the American economy. I think it's great, actually, that he brings up these issues of financial stability, and they debate, and quite openly, the idea that they could have a large insurance cut for some of the voters that, for them, could mean that they would possibly not have to cut later. And you have Rosengren essentially argue here that ultimately you can have problems later if they ease when it is not warranted. And I just point out that if you look at the last 20 years, we've had plenty of Fed easings, responses to negative financial shocks, but yet we have still had fundamental bubbles and busts and deceleration in inflation. And if they are ultimately out to stabilize inflation and to get a little bit of a buffer in terms of higher inflation, they can't afford a deeper recession later on in order to live for today.
I found it very interesting that he said at one point, I'm not focused on investors in particular, and then later said, look, we take out insurance when we need to, when we see the market is down substantially, and right here the market is up.
Absolutely right by the highs. The other point, of course, he made clear there were that the tweets from the president don't influence him personally. Couldn't obviously specifically comment for other members, but certainly implied they haven't been influenced by the president. Stephen Wieting, thanks for joining us.